Welcome back to Accounts Decoder. Today we are talking about how to record cash dividends, a simple but essential equity transaction that every accountant must understand. When a company earns a profit and decides to share a portion of it with the shareholders, it does so by declaring and paying dividends. But how do we record that? Let's break it into two stages, declaration and payment. First, when the board declares the dividend, the company now has a liability. It owes the money to its shareholders. This is when you record debit retained earning because profit are being distributed. Credit dividends payable to show the obligation to pay. Then comes the second stage when the company actually pays the dividend. At this point, you remove the liability and reduce the cash. So the entry becomes debit dividends payable, credit cash. Let's go through a simple example. Suppose the company declares a 1 lakh cash dividend. On the declaration date, the journal entry would be debit retained earning 1 lakh, credit dividends payable 1 lakh. Then on the payment date, when the dividend is actually paid out to shareholders, debit dividends payable 1 lakh, credit cash 1 lakh. This way, your books reflect the reduction in retained profit and actual cash flow, keeping your balance sheet and equity section accurate and up to date. To sum it up, at a declaration, debit retained earnings, credit dividends payable. At payment, debit dividends payable and credit cash. If this helped clarify how to handle dividends in accounting, hit like, follow and share Accounts Decoder, where we make a real life accounting easy to understand. Catch you in the next one.